Ind AS 2 question answers quick revision. Illustration 1. Whether packaging material and publicity material are covered by the term materials and supplies awaiting use in production process. Secondary packaging material and publicity material cannot be included. Primary packaging material essential to bring an item of inventory to its saleable condition, example bottles, cans, etc. Other packing material for transportation of in the nature of secondary packing material. Illustration 2. ABC Limited buys goods of 1000 units of component X, price rupees 1200 per unit, trade discount 5%, supplier offers early settlement discount of 2%, import duties rupees 60 per unit, delivery cost rupees 5000 to have the components taken to its warehouse. Calculate cost of inventory. Purchase price, which is 1000 into 1200 into 95%, reducing the trade discount. Import duties is also added. Delivery cost is also taken, which is total of 12,05,000. The intention to take settlement discount is irrelevant. Settlement discount is not included. Illustration 3. Business plans production overheads rupees 10 lakhs per annum. Normal level 1 lakh units per annum. Business only able to make 75,000 units in current year. Other cost per unit are rupees 126. Calculate per unit cost, amount of overheads to be expensed during the year. Calculation of cost per unit. Cost per unit is other cost, which is 126. Production overhead, this 10 lakhs divided by 1 lakh units gives per unit production overhead. This is the total unit cost. Overhead to be expensed. Total production overheads of this 10 lakhs minus the amount absorbed in inventory, which is 75,000 into this 10 multiplied with this 10 rupees per unit, which gives 10 lakh 50, and the balance amount is not absorbed, 2 lakh 50, which is not included in inventory expense, that is recognition statement of profit and loss. Illustration 4. ABC Limited manufactures control units. Each control unit requires one component of X of rupees 1205 each, one component of Y of rupees 800 each, raw material of rupees 150 each. Company incurs factory rent 16,500 per month, energy cost 7,500 per month, selling and administrative expenses of rupees 10,000. Each unit takes 2 hours to assemble. Production workers are paid rupees 300 per hour. Normal level of production per month is 1000 hours. Calculate cost of inventory. Solution: cost of single control unit, which is component X value taken, component Y value taken, raw material taken, the same data given in question. For labor it is 2 hours into 300, and for production overheads it is factory rent plus energy cost divided by 1000 hours, which is given here, into 2, because each unit takes 2 hours to produce, which gives total 2803. Note: the selling and administrative costs are not part of cost of inventory. Illustration 5. Conversion cost. Dealer purchased 1000 cars costing 2,80,000 each on deferred payment basis, 25,000 per month per car in 12 equal installments. At end of year 31st March 2001, 20x1, 20 cars are still in stock. Compute cost of inventory, finance cost, cost of goods sold. Solution: deferred payment. The total deferred payment minus the cash price gives the interest expense. Now computing finance cost, this 20,000 multiplied with 1000 total cars gives total finance cost. This 2,80,000 is bifurcated in two parts. The cash price, which is multiplied with 980, gives cost of goods sold. If this is when this is multiplied with 20, gives cost of inventory. Finance cost. Illustration 6. Venus Trading Company purchases cars from several countries and sells them to Asian countries. It has incurred the following expenses. The question is, evaluate which costs are to be allowed as per Ind AS 2 for inclusion in cost of inventory. Trade discount on purchase allowed. Handling costs related to imports allowed. Salary of accounting department, sales commission paid to selling agents, sales after sales warranty costs are not allowed, and they are straight away charged in statement of P&L. Import duties are allowed. Costs of purchase based on supplier invoice is allowed. Freight expense allowed. Insurance of purchases allowed. Brokerage commission paid to intending agents is also allowed, which is the buying commission. Illustration 7. As per Ind AS 2, advise whether the distribution costs would be included in the cost of inventory as per Ind AS 2. Solution. Distribution costs are incurred by the seller to complete a sale transaction. These costs are not related to bringing the goods to their present location and condition. Hence, these costs excluded from the cost of inventory. Coming to illustration 8. One byproduct BP emerges and two main products MP1 and MP2 apart from scrap are there, and cost of production are as follows. We have the values relating to raw material, wages, fixed overhead, variable overhead, the relevant amounts, outputs of main product 1, main product 2, and the byproduct, and the closing stock is also given. We also have market price of MP1, MP2 is 60 and 50. Byproduct is sold at 20. We have the units also. There is profit of 5,000 sale of byproduct, which is irrelevant. Separate processing charges of 800 and packing charges, and then 5,000 was realized scrap value. Calculate value of closing stock MP1 and MP2. This is very simple. Solution as per Ind AS 2. Most byproducts as well as scrap or waste materials are immaterial, measured at NRV and deducted from the cost of main product. Solution. Step 1. We compute NRV of the byproduct, the realizable value, which is 2020 minus the processing charge 8,000 and packaging charge. This NRV value shall be deducted from the total expense. Step 2, which is the total of 1,50,000, 90, 65 and 50,000. This amount, from this amount, the amount calculated in step 1 NRV of the byproduct will be deducted. It is seen here. 1,50,000, 90, 65, 50 deducted by 40 minus 8, by total 30. And also sale of scrap value shall also be deducted, and it gives us 3,20,000, which has to be allocated between MP1 and MP2. Coming to step 3. Allocate step 2 joint cost in the ratio of market value of MP1 and MP2. To compute the market value, we have units and also the market price. The unit and market price, which we get the ratio of 3:2, and then we allocate this 3,20,000 in the ratio of this 3:2. We get 1,92,000 and 1,28,000, which is divided by the respective number of units, which gives us 38.4 and 32. And next we have to determine the value of closing stock. This value multiplied with the closing value given in the question, we get value of closing stock. Illustration 9. Mass Fashions is a new luxury retail company that is located in Lajpat Nagar, New Delhi. Advise the accountant of the company on the necessary accounting treatment for the following items. First one, beauty products line, which has a short life cycle. Point of sale and inventory system is not yet fully functioning in this department. Sales manager is unsure of cost of each product, but confident that selling price is reliable, and company makes a gross margin of 65% on each line. Solution. Retail method can be used for measuring inventories. Cost is equal to selling price minus gross margin percentage. And second one, it also sells handbags, which it produces, manufactures 1 lakh handbags in a year in handbag division, and uses 15% of the space and overheads of the head office division employs 10 people. the solution to this is it is measured using standard cost. If results approximate cost, company has information of direct material, direct labor, direct overheads, and it is best to arrive at the cost of inventories. Next, coming to illustration 10, whether entity can differentiate cost formula for inventories held at different geographical locations having similar nature and use to it. Solution: different cost formula cannot be used for inventory valuation purpose. Illustration 11. Mercury Limited has provided the following data, which is the date is given, particulars, unit, cost, and then total cost. Total cost is there and the units are also given. Okay. Physical inventory is 400. Physical inventory at 31/3/2020x2 is 400 units. Calculate inventory value and cost of sales using FIFO and weighted average method. In FIFO method, the cost of sale is total cost minus closing inventory. We have the total cost, which is 12,250, and we need to calculate the closing inventory to deduct it from that. So closing inventory in FIFO method is first in first out. We go from here, which is out of 400 units, 300 units are purchased in Feb. 350 into 14 plus 50 into 12, which gives 5,500, which is deducted from total cost, gives cost of sale. Next, coming to weighted average cost per unit, which is 12,250 divided by total number of units. 12,250 of the total cost divided by total units, which gives 12.5. This 12.5 multiplied with 400 gives weighted average value of inventory. This is deducted from the total cost of 12,250, which gives cost of sales. Illustration 12. Recommend whether the following cost should be considered while determining NRV of inventories. Cost of completion of work in progress. Nature of completion costs, which are the work in costs deducted from the estimated selling price to determine net realizable value of work in progress. Trade discounts expected to be allowed on sale. Trade discount expected to be allowed should be deducted to determine the estimated selling price. Cash discounts expected to be allowed for prompt payment. These costs are not incurred to make the sale, not be considered while determining NRV. Illustration 13. ABC Limited manufactures and sells paper envelopes. The stock of envelopes, including the closing inventory on 31st March 2001, is cost of ₹50 per pack. Sale price at 15th April 20x1 was ₹40 per pack. Furthermore, inquiry reveals water leakage created damages paper and glue. ABC Limited spent ₹15 per pack for repairing. Calculate net realizable value and inventory write-down loss amount. Expected sale price is ₹40. Expected sale price is ₹40 less cost incurred of ₹15. NRV is 40 minus 15, which is 25 per pack. Loss inventory write down, which is cost minus NRV, which is 50 minus 25, which gives 25 per pack. Illustration 14. At the end of the financial year, company P has 100 units of inventory, which is ₹10 per unit. Current 10 per unit is the carrying amount, and current market price is ₹8 per unit. Sale contract with company Q to sell 60 units at ₹11 per unit. Estimated incremental selling cost is ₹1 per unit. Compute NRV of the inventory. Solution. We have NRV for 60 units, which is 11 minus 1, ₹10, and for the balance 40 units, the NRV available with us is 8 minus 1, which gives 7, and the total cost of inventory is 60 units multiplied with 10 rupees and 40 units multiplied with 7 gives 880. And the important point here is, therefore company P will write down these remaining 40 units by rupees 120, because this is less than 10 rupees and the difference between 10 and 7 rupees 3 into 40, which will be written down. Question 15. This is very simple. A business has 4 items of inventory. The cost is given, estimated selling price, estimated cost is given. We take estimated selling price minus estimated cost, the net amount, compared with cost, this amount, and lower of cost or NRV is taken for each inventory, and the total is taken. Illustration 16. Given particulars: opening inventory, finished goods, raw material, closing inventory, raw material and finished goods. Purchases are given, sales are also given in kgs, and also the value. Labor, overheads, fixed are given. Fixed overheads are given, which means we take it divided by the normal amount into the actual for absorption. The expected production is 15,000 kg finished product. Rupees 20 is the selling price of finished good. Replacement cost is rupees 9.5 per kg. Calculate closing inventory on that date. So here the main point is we have NRV of the finished good, which is 20. We compare this 20 of NRV with closing raw material cost, which we calculate by finding, which we calculate here, and it is also compared with the replacement cost. So first we see the cost of closing raw material cost. Calculation of cost of closing inventory. Cost of purchase is 10,200 into 10, which is 10,000 is the purchases plus raw material plus opening raw material minus closing raw material, into 10, which is 1,02,000. Direct labor given in question 76,500, and for fixed overhead absorption 75,000 divided by total units that were total finished product 15,000 into 10,200, which is the purchase units, which gives 51,200. Cost of production, the total is taken. This total is divided by 10,200, giving 22.5, and NRV is 20. Since NRV is less than the cost, closing inventory will be rupees 20. As NRV of the finished goods is less than its cost, relevant raw material will be valued at replacement cost of 9.5. Therefore, closing inventory is finished goods 1200 into 20, and therefore the relevant raw material, which will be calculated at replacement amount. This 1200 into 20 into 9.5. Next, illustration 17. Sun Pharma Limited, a renowned company in the field of pharmaceutical, has the following 4 items of inventory: ABCD, cost, NRV. On item by item basis, on group basis, on item by item individually, whichever is less is taken. Which gives this, and also group wise, the lowest of the total group. In example 7, an item of inventory costing rupees 20,000 consumed in construction of self-constructed property, capitalized in the cost of PP. 80,000 is the cost of PP other than inventory. Inventory capitalized in the cost of PPE, and depreciation on such property charged. This 80,000 plus 20,000 divided by 5, which is the life, gives 20,000, which means inventory has to be capitalized if it is used for construction. Or we are done with illustrations. Now coming to test your knowledge. Question 1. Purchase raw material at rupees 400 per kg. Company is having 10,000 kg of raw material in inventory. Company never sells the raw material, does not know the selling price of raw material, cannot calculate realizable value. Replacement cost of raw material is rupees 300 per kg. Compute the value of inventory of raw material. Solution: inventories. held for use in the production, not written down below cost if finished goods are expected to be sold at or above cost. Replacement cost of raw material may be best available measure of their net realizable value. Value will value the inventory of raw material at rupees 30 lakhs, which is 10,000 per kg into rupees 300 per kg. I mean 10,000 kg into 300 per kg, which is here replacement. Question 2. Customer has requested the company for postponement in delivery schedule and requested the company to withhold the delivery of finished goods. Discontinued production of balance items. Customer balance and the goods held by the company. Solar power panel work in progress 85 lakhs. Solar power panel finished goods 55 lakhs. This total gives 140 lakhs. Sundry debtors, a solar power panel 65 lakhs. Petition for winding up against customer has been filed during 2002 and 3 by Sun Limited. Advice on provision to be made of rupees 205 lakh that is included in sundry debtors, finished goods and work in progress for the financial year. Answer 2. Solar power panel held this stock to be considered as its inventory. Inventory at the end of the year is to be valued at lower of cost or NRV. Company should value inventory as per Ind AS 2, lower of cost or NRV. Though the goods were produced as per specifications of buyer, company should determine NRV and value the goods accordingly. In the absence of NRV in the question, assuming that the cost is lower, value its inventory as per Ind AS 2 rupees 140 lakhs, which is 85 lakhs plus 55 lakhs. Alternatively, if it is assumed that there is no buyer, then NRV will be nil. Full value of finished goods will be provided in the books. This is for inventory. And now coming to debtors. For debtors, since the company has filed a petition for winding up against the debtor against the customer in 2002 and 3, it is probable that amount is not recoverable. Hence, the provision for doubtful debts of rupees 65 lakh shall be made in the books against the debtor's amount. Next, coming to third question. Inventory of ABC Limited includes spare parts cost rupees 10 million at 31st March 2001. Expected selling price is rupees 12 million. On 15 April 20x1, due to market fluctuations, expected selling price is reduced to 8 million. Estimated selling expense is 0.5. Financial statements approved on 20th April. At 31st March 20x2, estimated selling price of inventory is 11 million. Estimated selling expenses are 0.5 million. Determine value of inventory in the following dates: on 31st March 20x1, 31st March 20x2. Answer 3. As per Ind AS 2, inventory shall be measured at lower of cost or NRV. As per Ind AS 10, net realizable value below cost of events occurring at the balance sheet date is considered as adjusting event. Cost of inventory would be 10 million and net realizable value would be 7.5 million, being 8 million minus 0.5. Inventory shall be measured at 7.5 million and the balance inventory write down of rupees 2.5 million recorded in income statement, that is P&L. The second part of the question, the amount of written down is reversed so that the new carrying amount of the lower of the cost and revised net realizable value. Cost is rupees 10 million and NRV is 10.5 million, which is 11 million minus 0.5 million. Inventory would be recorded at 10 million and inventory write down carried out in previous 2.5 shall be reversed. Coming to fourth question. The following information gathered from an entity: full capacity is 10,000 labor hours, normal capacity 7,500 labor hours in a year, actual labor hours and current period are 6,500. Total fixed production overheads rupees 1,500. Total variable production overheads rupees 2,600. Opening inventory is 2,500 units. Total units produced in a year are 6,500 units. Total units sold in a year are 6,700 units. The cost of inventory is assigned by FIFO cost formula, determine overhead cost to be allocated to cost of goods sold and closing inventory. The main part of the question is this. To arrive at this part, we calculate the absorbed fixed overheads and the absorbed variable overheads, which shall be deducted from the total fixed and variable overheads. So the answer 4. Hours taken to produce 1 unit, 6500 hours. 6500 hours divided by 6500 units, which gives 1 hour per unit. Fixed production overheads absorption rate. Fixed production overheads or labor hours for normal capacity, which gives 1500 divided by 7500, which is 0.2 per hour. Fixed product overhead allocated to 6500 units, which is 6500 into 1 hour into 0.2 rupees, which gives 1300. 1500 minus 1300, the balance 200 has to be recognized as an expense. Coming to variable production overhead absorption rate. Variable production overhead divided by actual hours. Here it is actual hours, whereas for fixed it is normal capacity divided by normal, here divided by actual, which gives 2600 divided by 6500 hours, which gives 0.4 per hour. Computation of closing inventory. Opening inventory plus units produced during the year minus units sold, which gives 2300 units. Total fixed and variable production overheads recognized as part of inventory, as part of cost of inventory, which is 2300 units into 1 hour into 0.2 plus 0.4, which gives 1380. Now 1500 the fixed overheads plus 2600 the variable overhead minus the total absorbed minus 1380 is recognized as an expense in the income statement as follows. Absorbed in cost of goods sold, 6500 minus 2300, which gives 4200 into 0.6, which is 2520. Unabsorbed fixed overheads not included in the cost of goods sold, which is rupees 200, total 2720. The last question number 5. Sharp trading purchases various countries. It purchases from various countries and exports. The question is, advise if which of the following item is to be included in the cost of inventory and wants to calculate cost of inventory as per Ind AS 2. Cost of purchase 5 lakhs based on vendor's invoice, trade discount deducted, reduced, import duties added, freight and insurance on purchase added, other handling costs related to imports added, salary of accounting department not taken, ignore, brokerage commission payable to intending agents for arranging imports means buying commission added, sales commission not included, hence reduced, after sales warranty is also not included. We only include the costs that are incurred up to the inventory is brought to the location. That is it. This is end of illustrations and test your knowledge on Ind AS 2.